I know you mentioned that macros are not something that one should get too obsessed about. But at the same time, when we tell people that you should consider investing in equity, one of the things we say is that India is poised for good growth in the next 5 to 10 years. Given the situation today, do you believe that the next 5 years for India as an economy look great and bright? I know it's difficult to make such a long, futuristic kind of a prediction, but on the ground, when you see things, are you able to convince your investors to say that, look, you've seen a great recovery in the Indian economy. We've now reached number 6. Yeah. And the years ahead look good for the next 5, 10 at least years.
So, look at it this way, that on macros, one is that we are buying stock of certain companies because we have a certain hypothesis about their earnings potential. So my idea is not that we should be completely oblivious to macros. What I mean to say is it's my job, but I would definitely not labor investors with getting into macros.
Sure.
So we are paid for keeping the macro environment in mind because that's the operating context in which a lot of companies operate. And like I said, I stick to my point that all said and done, these macros can only prepone or postpone your return. They cannot indefinitely deny you what return you're going to get because the companies are producing some results. Now coming to this point about India, there are these 3 months, 6 months, 1 year, 2 year, the facts and the perceptions, they keep changing. Markets are bullish, markets are bearish, there is good news, there is bad news. But in the background, there is a bigger wave or a tailwind which one needs to keep in mind. I was recently at a conference in Europe where a wealth manager from Canada made a very long presentation. At the end of a 1 hour presentation, he said that, if you listen to my recommendations, you buy real estate in that country, private equity in this country, and I'll make you a portfolio, and probably you will get weighted average 4% return. So I was sitting next to someone who was a European gentleman, and I said, look, I just show up to work at 9 in the morning and we produce 12% compounded over 10 years. So it's not that we are extraordinarily brilliant people. The point I was trying to make to my neighbor at that point was that you need tailwinds for you to actually perform. So we are in a space where overall the country is growing, overall the economy is growing, and it is tailwinded because of the demographics. It is tailwinded because we are under-penetrated in so many sectors and so many segments. Now you look at it this way, that internationally, banks are a very normal service to have. Whereas we live in a country where the Prime Minister has to come on television and say, please open bank accounts. It's the government's agenda to ensure everybody has insurance. And for example, we are living in a country where the first insurance company got listed a year back. 10 years back, our per capita income was $1,000. When your per capita is $1,000 and the cost of roti kapda makan is $900, then obviously your disposable income is $100. But when your per capita goes from $1,000 to say where we are now, nearly $2,000, then the cost of roti kapda makan doesn't go from 900 to 1800. It will go by say 1400.
Sure.
So the point is that every time the GDP grows, every time the per capita grows, the disposable income, the ability to save, invest, buy insurance, consume stuff, that rises. So long story short is that we will always have certain pockets which are giving us good growth, and that is what will help investors make returns.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.